Welcome, everybody, to this webinar, Foundations of Technical Analysis. We are at part 3 of 5, and returning to us is Patrick Ceresna. Patrick, I hand it off to you.
All right, thank you very much, and hello everyone, and thanks for joining me. Those of you that have been with us for the series and already know me, but those that are just coming into the series, my name is Patrick Ceresna from Big Picture Trading and host of the Macro Voices and Market Huddle podcasts. Make sure you download those podcasts and listen to some great market analytics. So in part 3, our focus is to move on to what are known as technical overlays. And the difference between an indicator that goes underneath the market and versus an overlay is the overlay goes over the price chart. And so the most well-known one is moving averages. But we're going to talk moving averages, moving average envelopes, and Bollinger bands throughout the session. And the goal is for us to get a good foundation on this. In part 4, we're going to get into the indicators that go underlay at the bottom of the charts, and then we'll put it all together with trade plans in part 5. And so let's just take a dive into this. So the first thing I just want to very quickly review again, and I want to just repeat this at the start of each one of the webinars, is why you use technical analysis. And I always just want to reiterate the same point, that fundamentals offer us only an understanding of value in comparables. So, how cheap am I buying a stock, or how does the stock value versus its competitors? But technicals are the observation of how investors are actually allocating money, because trend reflects sentiment, and the price movement is a reflection of the buying and selling orders. And so what we're doing is taking the secondary layer. I never ever want anyone of you to misinterpret that one would say technicals are better than fundamentals or vice versa. In fact, they are very complementary. Understanding fundamentally good things and then looking technically when the trends are emergent is a beautiful complement, and it's always a great way of investing and trading. So let's take a dive into moving averages. And so the first component of moving averages, we're going to talk about the simple moving average, or just the moving average as it's known. We're going to look at trade signals, look at different durations or periods, and we're going to apply it to even intraday charts. So some of you may be inclined to want to intraday day trade, and we'll look at how moving averages can be applied that way. At the same time, we'll then also just elaborate on what are weighted moving averages and exponential moving averages. So let's take a dive into it. So the key to the most basic and simple moving average is that it's arithmetic. In fact, back in the day when charting was just on a graph paper with on little chart books that was mailed out to people, there was no computers back then. It was very simple to track a moving average because it was simply the accumulation of an X number of closing prices divided by the amount of closing prices you added together. So it becomes just a simple way of looking at what was the average price over a fixed period of time. The most common moving averages that have been tracked through history have always been the 10 and 20 period moving averages for very short-term trends, and the 50-day and 200-day moving averages, which have been very well known for longer-term trend analysis. And so let's take a look at these moving averages and how it looks. So here what I'm illustrating is a 10-day moving average. And so at any one of the points to connect the blue line together, all we're looking at is, in this situation, what was the average price of the last 10 closing prices. And what it's doing is it's simply giving you the average price. So therefore, if a price is sustaining above a trend, then that means above the line, it means that it's in an uptrend. And you can see here how the price has a very clean tendency to stay on a sustained basis above or below that moving average. The key thing to never lose sight of is that it's just basic math, and therefore the average price or the moving average line will always be lagging. we do use it for signals, but it's a trailing price that is always just trailing behind the price because it's an average of the price sample. And so one of the most simple ways investors and traders tend to utilize moving averages is that they will look when the price crosses above or below the moving average for a signal to buy or sell. And you could keep your technical analysis as simple as this. One just needs to understand why you would consider it. As you can see, in this period on this index, you can see that 10-period moving average did a pretty good job of identifying major turn points in the markets by when it shifted above or below. But while you can identify these beautiful turn points that appear on the surface to have made great money, at the same time, if you notice where I circled the blue area on the chart, notice how many times the price closed above and then below and then back above and then back down below. Even there's some areas that I didn't circle that you see closing prices that went through the moving averages. By using just a simple moving average like this, and if you were to build a trade system or model or a discipline where you buy or sell when it's getting above or below, you may experience what the word there you see on the chart as whipsaw, which is that you go into a trade and the next day it closes below and you get out of the trade and then it closes back above. I mean, in the end, the moving average is just the average price that the stock is traded over, let's say in this case, the last 10 days. And so if you're stuck in a trade range versus a stock that is trending or an index that is trending, then it's going to often just chop back and forth above its average price. And this is where what that term we call whipsaw or false starts can actually occur. And so we're going to discuss as we move to the next couple of slides how one can manage this, or what are the alternative ways of overcoming this. But really, I think the key takeaway here is that as long as you find some reasonable way to manage that risk, then often you can just use a simple moving average just as a simple guide to whether or not the trend is in your favor on the stocks that you want to own. So what I wanted to just compare was the four most commonly used moving averages. There are people who use a 100-day. There's people that use a 13-day moving average. I mean, you can have any average you want, but probably the single most commonly used moving averages are the 10, 20, 50, and 200-day moving averages. And all I wanted to illustrate in this chart by showing the gaps between them is simply illustrating that the more days that you average, the more the line, the more of a price move it takes for the line to have any response. So think of a 200-day moving average. It's averaging the price of 200 days. And so one change in one day averaged against 199 prior trading days is going to have the moving average offer little to no immediate response. It would take a sustained trend of price movement in order to drag the 200-day moving average higher. At the same time, a 10-day moving average, the blue line, which is sampling a much smaller sample of data, is far more responsive. And so when a lot of the bigger analysts out there often like to reference a 50 or 200-day moving average, one of the reasons they anchor themselves on that is that they're not looking for the short-term tactical swings in the stocks or the indices, but rather want to get a good gauge on the primary trend. And because the 50 and 200-day moving averages are averaging that big sample size, is usually a very good way of gauging as to what the primary trend of the underlying is. And so that does. Some people will, for instance, use a 200-day moving average, and they'll use that as their arbiter of whether we are in a bull market or a bear market. And they will say, you know, like all of that price that stays above a 200-day moving average, they just stay fully invested throughout it. And they're waiting for the break below the 200-day moving average to suggest to them that the bull market that it was, let's say, in place has shifted. I'm not. I don't want to suggest that is a great strategy. I'm simply pointing out that is something that you commonly can see if you're following people on that use technical analysis to reference that 200-day moving average as that kind of a pivot. So this is where I wanted to just give lip service to day trading and the use of moving averages. So notice here what I've done is I've switched the trend from a daily chart where every candle was representative of one day to now we switched it where every candle that you see is representative of 1 hour. And so now this kind of zooms in like a magnifying glass on the trend. And so you can utilize moving averages in the same manner as we did on daily charts on any time frame. So in this situation, you can see a 50-period moving average. Now notice we went from 50-day moving average to 50-period because what now we're doing is averaging 50 one-hour candles to get the trend line behind it. And so when you set on your TD platform, let's say an intraday chart, such as a 1 hour or a 5-minute chart or let's say a 30-minute chart, you can still utilize moving averages. All they're doing is providing you a moving average for the time period that you're looking at. And it's very important to make that distinction. But what I've found is that if you are a fan of moving averages, you will see that you can identify and use them strategically on all time frames. So if you are inclined to want to trade more on an intraday basis, the moving averages often can offer you just as much value as someone that is using a weekly chart looking for major multi-year trends. It's the really neat part about the use of moving averages as a strategic tool. So now this is where I want to move on and talk about the different other types of moving averages. And this is where I want to move on and talk about the weighted moving average. And the weighted moving average is basically weighing each price point to a different weighting. The goal is to make it more responsive to the most immediate price move. By weighing the most recent price move more than the price moves at the back end of the sample, what it does is it forces the moving average to turn quicker. And for active traders, they find this very appealing because if you're recognizing that a moving average is a lagging indicator because it's averaging the price, if you're waiting as a technician for the moving average to give you your buy or sell signal, you're more inclined to want a quicker response to give you potentially an earlier entry into your trade. Now, the weighted moving average actually has much of the same characteristics as an exponentially weighted moving average. All you're doing is changing the math from which the weightings to each candle or to each data point is weighed. So the weighted moving average is more of an arithmetic kind of very linear weighting, while an exponential weighting exponentially weighs the more recent data more than the back data. And so they both have the same characteristics. So I want to just demonstrate here on a chart is that when we take a 10-day simple moving average, weighted moving average, and an exponential moving average, they're all measuring the exact same 10 days. But notice some of the characteristics. Notice that when the stock market rolls over or it breaks out, notice how the blue and black lines more rapidly turn and follow the trend much quicker than the red line, which is very kind of, it takes its time to turn. The whole goal of someone that uses an exponential or a weighted moving average They just want that responsiveness in it. More often than not, I think it's splitting hairs. To be honest, whether you're a good trader or not and can make effective trading decisions, which of these moving averages you chose to use is, I don't necessarily believe, going to be the deal breaker on whether you're successful or not successful. But I mean, on these platforms, the TD offers you all of them, so you might as well know how to differentiate them. But really, the key is to understand how you're going to manage your trades through using them. But this is how you can see the way that they respond. Again, the blue and the black lines, you can see more actively turn higher and lower faster, and that's because the most immediate data is being weighed more heavily, turning those charts higher. So now I want to talk about the technique that is most commonly utilized to smooth out that term that we used earlier, the whipsaw, that when you were using the moving average as a buy or sell signal, you saw that there were periods where it closed above and then closed below and then closed back above, and somebody who simply was trading in a way that's saying, I will buy when it's above and sell when it's below, would have just experienced that whipsaw of in and then out and then in and then out. And so how do you smooth that out? Can we use moving averages and reduce the noise? And using moving average crossovers has been one of the techniques that traders have turned to. So a moving average crossover is just simply looking at two moving averages of different periods and waiting for them to cross over. By waiting for one moving average to cross over another, it lags the signal a little bit and therefore reduces the amount of times you can experience a whipsaw. The best way is simply to illustrate it. So looking here on this chart, I want to show you those chart we showed earlier, which was simply using a 10-period moving average, and this idea is that you buy or sell whenever it closes above or below that moving average. And notice that blue circled area is a good illustration of you get in and then you get out and then you get in and then you get out, and you're just being whipsawed was the term we used. So how does moving average crossover technique smooth that out? Well, notice I'm going to take the exact same chart, and what we're going to do is add with this 10-period moving average that you see on this chart, all we're going to do is add a 20-period moving average in red. And so notice what we've done here. Actually, sorry, the colors are mixed up. In this situation, the 10-period moving average we were looking at is red, and the blue is the 20-period moving average. The other thing that I just wanted to illustrate that's different from that previous chart is that this particular one is using the exponential moving average. You'll see that it wouldn't have made a big difference if we were using the weighted or the main moving average one. It just so happens in this illustration, I'm using the exponential. But notice here, for instance, where we had that circled area in the middle of where it was being whipsawed in and out, notice that the moving average, it was not enough price action movement in order to trigger a buy or sell signal. What it did, it reduced the amount of times that you would get whipped in or out of a trade. Now, by doing this way, it also lags it a little bit, which is the buy signal comes a little bit later. But some people prefer that so that they know that the primary trend is established. I'm not trying to, by the way, in any way give any of you a message that one way is definitively better than another. All I'm hoping to do is inspire many of you to go and discover for yourselves as to which technique kind of matches your personality as to what you want out of the markets and how you intend on trading it. With this, the point being here is the actual signal to buy or sell will come with the crossover of the faster 10-day moving average above or below that slower and lagging 20-day moving average. And you're getting the buy and sell signals along the way. And so this technique can, again, using that day trading example, be utilized even on an intraday basis. So what I have here is a chart of 2 days of 5-minute candles. So now we're talking like zoomed right into outright day trading 5-minute candle charts. And you can see using the same crossover of the 10 period moving average over the 20-period moving average, because remember, now we're measuring 10 5-minute candles, not 10 days, right? So that's why we switched to using the word period. What you can still see is that even though there was lots of intraday little whips, the 10-period moving average crossover over 20 gave the day trader a really interesting outcome using a zoomed-in sample of on that chart that we were looking at earlier. And so this is what someone that's using the moving average overlay is looking for. So I want to move on and talk about moving average envelopes. And so what is a moving average envelope, and why would we consider it? And so moving average envelope, what it is it's a trend-following indicator or overlay. What we're doing is trying to identify overbought and oversold conditions. So the easiest way to think of it is that if a moving average, let's say 10 or 20 period moving average is average of the last 10 periods or 20 periods, if a price dynamically moves away from its moving average, it would indicate that it's stretched or overbought in one direction, and at some manner or another is going to mean revert. Mean reversion could be it's simply pausing while the moving averages catch up, or two, it could drop back down and come back into the ranges. And by adding envelopes around the moving averages, this allows us to be able to visualize this. And so here's an example. So what we have here on this index is a 10-day moving average. That's the same moving average we've been looking at in the first 20 minutes of this presentation. But the blue band around it is an envelope that is a 2% higher and 2% lower band around that 10-period moving average. And what you can observe here is that it does a very good job kind of wrapping around the majority of the price action. And you're identifying periods where the price accelerates past that band to identify extremes in the markets. Now, whether the extreme is a buy or sell signal or some other thing, every trader has a little bit of a different style. But when you put an envelope on, it's helping you visualize and identify periods where the market is overextended. And that's really what you're trying to achieve when you're putting an envelope on it. Notice that you can play with the settings. So in this situation, this was a 10-day moving average with a 2% band. Notice I'll take the same sample and I will put a 20-day moving average with a 5% band. Now, this is the well, when we get to Bollinger bands in a moment, it helps overcome this. But the biggest obstacle for traders utilizing these bands is that you almost have to right fit each band based upon the implied volatility of the underlying. And as we move on, I will explain this. But what you're doing is you're looking for some sort of an envelope that encompasses the majority of the price action, so you can identify very easily visually when a market has gotten simply too overbought or too oversold. And you can see rarely did on this chart the price touched the outer envelope 5% away, while when we did a 2% band in the earlier slide, you can see numerous times where the price was touching the 2% band. Each trader, depending on what you're trying to get out of the band, will use the settings to try to identify when there is that extreme price movement that touches the outer bands of that move. So volatility is that important consideration in all of this. And why is that? Well, because a stock index is going to have, for instance, a lot smaller volatility than, let's say, an individual high beta stock. And while I don't reveal the name of the security on the next chart, it's a cannabis stock that has a much higher volatility, almost 4 times greater than the index. And so notice that when I put the same 10-day simple moving average with a 2% band over this cannabis stock, you can see that the price is almost always outside of the band because the volatility of the underlying security is not only huge, but also 2% does not very well encompass the type of volatility one experiences on this chart. And so what happens, one of the shortcomings of using these volatility bands on moving averages is that as you're going stock by stock, you almost have to right fit the volatility to that volatility band. And this is where, when we get in moment of Bollinger bands, that is subsequently done for you automatically in the way that the Bollinger bands are calculated. This is not available to us for envelopes. Often, traders that prefer using moving average envelopes over that of Bollinger bands tend to be watching one security constantly, and they know what band they're looking for. While those traders that are scanning hundreds of stocks and are looking at using will often turn to those Bollinger bands, which I'll explain to you in a moment, because then you don't have to mess around with the settings. And so just as an example, let's say you suggested to yourself that you are inclined to always trade the TSX 60 or index or the S&P 500 index ETFs. You can easily discover an envelope band around the moving average that fits those indices. While, again, if you're scanning hundreds of stocks, you want something that's more versatile, as then you don't have to right fit the bands as much. So the goal of moving average envelopes is to try our best to identify overbought or oversold conditions. And so in this situation, you want to see where the price has extended itself outside of the band, so that way it may offer an opportunity. Think of it like an elastic band between your two fingers. When you stretch it to the maximum, then the natural force is to draw it right back, your fingers back together again, because of the tension that is built in there. And so when a stock overshoots in one direction, it may be so overbought or oversold that then the tendency is for it to mean revert. And the envelopes are a way of identifying stretched markets. And so here I'm capturing a very volatile period in this index, where you can see is that every time it blew out of the band, inevitably it returns back into the band. That doesn't necessarily mean that's going to be a profitable trade, buying when it closes above or below the band, but it identifies extreme moments in the market where one may be inclined to take an action. Particularly, I know certain traders that will use this more as an exit strategy. So they may have turned around and bought or sold a security based on something like a moving average indicator, but they will identify extremely extended markets as a way to take profits or to exit a trade. And so I kind of identifying when a market has left its normal trade ranges and is overextended may be actionable as an investor or trader, not only just to enter, but also as an exit, right? So this is where I want to spend a little bit of time just talking about Bollinger bands. So Bollinger bands have the same principles as moving average envelopes. But what happens here is that they wanted to overcome this idea that you had to continuously be adjusting the percentages on the bands. And they came to this the solution of, well, why don't we base it off of the volatility of the underlying and make the band a certain standard deviation away from the moving average based upon that volatility. So this allows you to be able to move from one volatile stock to a less volatile stock, and the Bollinger band will automatically adjust based upon that stock's volatility, and subsequently making the bands always work well. So the default settings on Bollinger bands for most technical services is a 20-period moving average with a 2 standard deviation envelope around it. And so when you put on a Bollinger Band, so notice how it looks on the chart versus that of the envelope. The envelope was very symmetrically wrapped around. But as the security is getting more volatile or less volatile, the Bollinger Bands are widening and tightening based as the volatility is changing, and therefore what happens is that you don't have to mess around with the bands. But it also is an interesting observation that as these bands are even widening, if a stock is able to make it outside of its volatility bands, that really does indicate an overextended market. And so let's kind of look at how we can use these Bollinger Bands to get insights onto the markets, and how some traders tend to use them for opportunities. And so what I want to look at here is comparing Bollinger Bands to those moving average envelopes. And so notice, going back to that cannabis stock I was referencing earlier, notice that using a 10-period moving average with a 2% band was completely a wrong fit. And so you'd have to mess around with the settings to discover what is the right fit around there with the envelopes. But notice once we switch to a 10-period Bollinger Band, moving average, with 2 standard deviation band, notice how on that exact same security, the Bollinger Bands captured the ranges much better than the envelope did. And so this is that self-correcting mechanism within the Bollinger Bands that makes so many traders find them appealing. And so the Bollinger Bands are just adjusting based upon the actual volatility of the underlying security, and therefore setting the envelope around it that way. So the question many are thinking, well, how do I actually trade the Bollinger Bands? How do I make investing or trading decisions based upon them? Now, intuitively, most people would naturally be inclined to suggest that the touching of the top end of a band would be a sell signal, or vice versa. That is not often the case. What a lot of traders that use Bollinger Bands will argue is that it's actually a signal of strength. A stock that is able to trade at the top end of its volatility band is demonstrating momentum and strength and healthy accumulation. And so what they often will look for is a stock to do a term they call walking the band. And walking the band, it looks like this, which is that once the price approaches and touches the top of the Bollinger Band, often traders will look for that price to continue to walk to the top of the band, which is that the trend will continue to sustain and continue to push while it's continuously testing the top end of the band as it's going along the way. And so the one thing that we do not want to automatically assume that if a stock touches the edges of its Bollinger Band, that it somehow guarantees it's going to revert back to its moving average. There are periods where they're actually a good signal of sustained and continuous price action. And so walking the band is a Bollinger Band term that they would often use. So now, what happens if a price is so strong that it actually leaves the bands that it's the Bollinger Band zones? Well, as noted by many technicians out there, that because 2 standard deviations will around the band will encompass often 90% of the price action. It varies slightly, but on a whole, because it is based on its volatility and it's determining a standard deviation of that volatility, it's very hard for it not to encompass 90% of the price action. And therefore, if a price has sufficient momentum to beat its Bollinger Bands higher or lower, it truly does signify a volatile event, an extreme momentum moment. And so while walking the bands, which tends to stay within the Bollinger Bands but is testing the top or the bottom of the Bollinger Band sequence, when you experience periods where the momentum is so strong that it's actually trading outside of the Bollinger Band zones, then it is an indication that there's a very profound and important trend developing. Because of the tendency for the markets to accelerate to the downside faster than they tend to rise, more often than not, you see the Bollinger Bands being blown out on the bottom end. But you can see even on this chart, which I did not circle, a couple of times when the price left the upper Bollinger Band zone, and it did mark some sort of a short-term overbought condition. Not necessarily always a reversal of trend, but at minimum, at least it shows where the price was overextended sufficiently in order to cause it to mean revert a little bit along the way. But so the extreme momentum is when those Bollinger Bands are 2 standard deviations away, and the price is actually trading outside of that band, and that often it can be extreme enough that it will eventually create that reactionary move the other way. Now, a price leaving or walking the Bollinger Band tends not to be when a lot of traders make their reversal trades. And this is, if you recall in our earlier modules, when we were doing the first module and the second module, we were talking about patterns such as double tops and double bottoms. And what happens is Bollinger Band traders have a tendency to focus on identifying when those shifts in momentum are occurring to create what are known as W bottoms or M tops, which shockingly is a double top or a double bottom, just so they give it a fun name. And what you can observe when a double bottom is developing, notice here as the price is leaving the Bollinger Bands and showing extreme momentum, often Bollinger Band traders will wait for the second dip where the right part of the W, where it doesn't touch the Bollinger Band the second go around. And so what happens is that the first extreme price action is not where they choose to consider taking action, but they're waiting to discover where the price no longer has the same momentum and therefore has the best chance of reversing. And so they'll look for the pattern, kind of a double bottom, after they see the extreme price action actually develop. And that's obviously the reciprocal, which is the M top, which is that the rally is very strong, exceeding the top end of the Bollinger Bands. Then you have a little dip. It comes in double top retests, and the second leg of the rally just was not as strong at all, was not able to reach the Bollinger Band tops the second time. It creates a topping formation, and often that is when using Bollinger Bands, traders tend to be inclined to trade a reversal of the trend. And so these are just different ways. I mean, the goal of this was not to give any of you some magical holy grail of something that will always be right and never wrong. That's never should have that impression. But when you're studying price action, when you're looking at how investors and traders are behaving and how they're voting with their money, these technical overlays are a tool that traders will use to kind of put a pulse or a gauge on momentum within stocks. And when we get to the next series, you will see that we're going to then worry about how other ways of measuring momentum with other technical indicators. So just as a conclusion, when we use technical overlays, what we're doing is trying to identify primary trends. Just is the trend your friend? Are you on the right side of it? Are you in something that is in a very healthy way sustaining above its moving averages and staying cleanly in trend? It helps us try to identify when there's extreme markets and then reversals in that momentum. and obviously subsequently momentum shifts that come with that. And so traders that develop a methodology using these are looking for ways of simply trying to always identify when to be in a security and when to trade it in its primary trend. And so in our next phase, when we get to part 4, we're going to go to look at indicators. And in those indicators, we're going to talk about everything from RSI to MACDs to stochastics. We're going to look at what traders look at underneath the charts to try to help them better understand the price trends that are emergent. And then we'll eventually get to part 5, where we're going to put all of this together and talk about creating some sort of a trade plan of how to buy, for you to make a set of rules for how to buy and sell utilizing technical analysis. Nonetheless, that's where we'll wrap it up for today. Again, my name is Patrick Serezna from Big Picture Trading. You can follow my work at bigpicturetrading.com and follow our podcast at Macro Voices in the Market Huddle, available on every podcast player on your phone. Anyway, thank you very much, everyone, for joining me.
And thank you so much, Patrick, for joining us. We really do appreciate it. We are looking forward to the next installment. And now we go to questions.